Welcome to episode 628, LeonCooperman, 50 Years in Wall Street, 10 Lessons. This is an outline of episode 628, lesson 1 to lesson 5. This is an outline of episode 628, lesson 6 to lesson 10. Lesson 1, don't do it for the money. You must have aptitude.
What sort of advice would you give them?
So, you have an aptitude for the business is number one. Don't think about the business for money. Think about it, what do you enjoy doing? Do you enjoy looking at numbers? Do you enjoy analyzing numbers, understand statistics?
Lesson 2, work very hard. He's a legendary workaholic. Maybe anyone who works more than 2 decades at Goldman Sachs is a workaholic.
I work very hard. I work 70-hour work weeks, plus I work 7 days a week, but I enjoy what I do. And I don't look at it as work.
Lesson 3, good intuition. For example, he abandoned dental school at the University of Pennsylvania after just 8 days.
Well, I would attribute whatever success I've enjoyed, frankly, to good luck, hard work, and good intuition.
Yeah.
I call that intuition, so I went back to Hunter College, City University of New York.
Lesson 4, he's a value investor. He applied Benjamin Graham's philosophy of investing. He's a good friend of Mario Gabelli and Warren Buffett.
I enjoy working with numbers. I enjoy working with people. Ben Graham in The Intelligent Investor hypothesized that the security analyst evaluates management twice in the investigation. Once through the numbers, because after all, when you look at a company, their return on equity, their market share, their profit margins, their return on capital is a function of the quality of management. And then you meet the management face to face, you interrogate them, you ask them questions, and you see how they respond to your questions. And, it's something I just found, an affinity for, an enjoyment. And what I
Lesson 5, luck. He chose Goldman Sachs as his first job in Wall Street by luck. He worked there from 1967 to 1991.
I have. It's actually one of the lower offers, but I liked everybody I met. And I was very familiar. And the job offer was about 11,500 or something like that. And keep your nose clean, I think you could do it. So I said, okay, I'll accept the job. And so if I look back, Goldman is one of the few firms whose names didn't change for the last 50-odd years. I could have gone to Goodbody, I could have gone to Kuhn Loeb, Loeb Rhodes, Hornblower. There's so many different firms that are no longer around.
Lesson 6, be very adaptable. He's Cooperman, who spent more than 50 years in Wall Street. He changed his plan 5 times. His plan A, to be a dentist. Plan B, he was an engineer. Plan C, he got his MBA from Columbia University. Plan D, he worked at Goldman Sachs. Plan E, this is his last plan. He started his own hedge fund at the age of 48. And the hedge fund would make him a multi-billionaire. Lesson 7, 3 conditions for starting a hedge fund at the age of 48. I hate to use the word old, but
when I started the business in '92, people would say, you're a financially comfortable guy. Why are you even doing this? Okay, and I'm going to do it as long as 3 conditions exist. Number 1, basically, I'm healthy. Okay. Number 2, I'm generating acceptable returns. And number 3, I'm having a certain amount of fun. If you do what you love and love what you do, and you have a bit of luck in life, you're bound to be successful.
Lesson 8, for insider trading accusation, the SEC won, even though the settlement was $4.9 million in 2017. That's because Cooperman's client started an exodus. His asset under management dwindled from $10 billion to $3.6 billion. Lesson 9, he trades according to market directions.
We do well. We try to make money for our investors in 5 different ways, but the 5 ways we make money are, number 1, basically is market direction. I don't care how smart you are, a rising tide lifts all the ships, a receding tide lowers all the ships. So we spent a lot of time at Omega, my partner Steve Einhorn is vice chairman of the firm, studying the economy, the Fed, market valuation, and tried to determine whether the stock market's undervalued going up or overvalued going down, because that determines our exposure to risk assets. Stocks are higher risk assets than is cash and short-term bonds. And so if you think the market's going down, you want to be defensive.
Lesson 10. The most important for stocks is free cash flow.
Is to recommend securities that are basically selling below that band of intrinsic value, which is a result of growth rates, returns, cash flow generation. The most important thing to me is free cash flow. Because unless the company is generating free cash flow, there's nothing, they have no luxury of pursuing other alternatives. So with that free cash flow, they can invest in their business, they can buy back equity, they can pay dividends. That's the elixir that keeps things going. So I say free cash flow.
Thank you for watching. Please subscribe and leave your questions and comments below. Do you know anyone who works in Wall Street? Wishing everyone peace and prosperity.